Hello and a warm welcome to a brand new episode of ET Markets Money Talk. Right here on ET Markets live stream, your own destination to get all wealth related news and be a part of discussions that matter. My name is Deepika Dhanda Singh, and today we have with us a very special guest, Mr. Harish Menon, co-founder and head investment advisory, House of Alpha Wealth Management. He's a chartered accountant by qualification, having more than 18 years of experience in financial markets. Today, we will talk about fixed income investment strategy. To answer all our questions, I welcome Mr. Harish Menon.
Thank you, Deepika. Good morning to everyone.
Thank you for being a part of the show. To begin with, I'd want to ask you, what is the concept of fixed income assets and what are its different types?
Fixed income asset refers to any securities or asset class where the money that you invest will be more or less secured. You will not have a lot of capital loss risk in that kind of security. The objective would be for the investors to earn a steady rate of return. So they're essentially saying that I'll park my money and I'll earn a steady rate of return, which will not fluctuate a lot. Also, more importantly, my capital will be preserved. I don't want any capital loss risk in this kind of investment. So that is what I generally refer to as fixed income securities in the market. There are different types. The most basic one would be a fixed deposit. If you go to a local bank around you and place an FD, that's an example of a fixed income investment because FDs are safe, you don't lose the capital, and you will get an assured rate of return at the end of it. There are other market securities as well, like government securities, corporate bonds that are issued by companies which do some businesses. You can also invest in fixed income securities through mutual funds. So, most mutual fund houses have fixed income schemes which can range from a 1 day investment horizon to as high as 10 years also. Depending upon what the investor is looking for, they can invest in various fixed income schemes where, again, in most likelihood, the capital could be protected if the securities are invested in safe bonds. And you will have an indicative rate of return that you will get, which will not be fluctuating like you will see in equity. So that's the nature of fixed income investing.
And what are its different types?
So as I just mentioned, right from fixed deposits to government bonds to corporate bonds to investing in fixed income mutual funds, these are all examples of investing in fixed income securities.
So, what is the consensus interest rate outlook for India right now?
So interest rates are largely a function of inflation. Most central banks, including Reserve Bank of India, is mostly focused on ensuring that inflation is kept under control. India is largely a developing country. We have a large section of country which is still below the poverty line. So for them, rise in prices are very, very critical. So Reserve Bank of India looks at factors that are connected to inflation. And one of the most important factors there is the crude oil prices. The global oil prices are very critical for us because we are an oil importer. As we speak today, the global oil prices have kind of stagnated. They are not really showing signs of rising like they were last year because of the Russia Ukraine war crisis. As of now, the war crisis is also hopefully abating as we speak. As long as the oil remains under control, as long as the inflationary pressures are not very high, the general consensus now is that RBI is very close to the last interest rate hike in the current cycle. So we would probably be having one more hike of maybe 25 basis points, and we will probably wait and watch for what the inflation will do. So I think we are very close to the peak of the current interest rate cycle. If I may take a view, that would be that.
And what is the present scenario of bond yields and the yield curve in the bond market?
So that's an interesting one because bond markets always work on preemptive moves. So they don't react to what is happening in terms of rate actions. They predict. They analyze all the factors. They will think about what will RBI do going forward and then act accordingly. So the shorter end of the yield curve, which means you're investing for let's say 1 year, 2 year, 3 year kind of horizons, those interest rates are more aligned to the actual interest rate decision of RBI. So if RBI hikes, for example, in the next monetary policy committee meeting, the shorter end of the yield curve will react to that. The medium to long term end of the yield curve, which is 5 years and beyond, they are more driven by expectations about future interest rate. So if they are more or less convinced, if that bucket is convinced that the interest rates may not go up a lot, then they don't react too much to the current rate cycle that you will see. So currently we are in this consensus mode where most of the market participants feel that we are close to the interest rate peak. So what you will see is more of a flat yield curve. So the 1 year yield currently is going at around 6.7, 6.8%. The overnight of RBI is around 640. So there is a little bit of a 40 basis point spread there. The 4 to 5 years interest rate horizon, the 4 to 5 years yield, is currently trading at around 720, 730 levels. And from there on, the yield curve is very flat. So the 10 year is currently at only around 735, 740. The 15 year is around 750. So there is not much of premium you're getting beyond the 5, 6 years interest rate yield curve. So what you're seeing is a little bit of a steepness in the short end and then a very flat yield curve. That's the current market structure, which essentially means that most market participants believe that maybe we will have one more hike and then everything will be stagnant. So they're already waiting and buying long term bonds in anticipation of maybe interest rates softening in the next 2 to 3 years.
In fact, well said. Now, before we sort of go ahead, I'd request each and every one who's watching the stream right now, just say hi, wave at us, and if you have any questions, do let us know. We'll take them up with Harish. Now, let me move on to my next question. How should an investor approach fixed income investing given the current interest rate environment?
So, what I would recommend to anybody in a generic form, so to be honest, we are in the business of wealth management. So, investments is always a function of everyone's personal income levels and what their risk appetite is. So, obviously, each one's portfolio would be different. But in a generic way, if I have to answer, I would always recommend that you should have two components into your fixed income bucket. One should be your core, very steady fixed income component, or that part of portfolio where you're very, very secure and you're ensuring that there is no capital risk at all. In that aspect, in that bucket, you would want to have something like government security funds or corporate bond funds, which are very high on credit quality. So you would want to have only AAA rated bonds in your portfolio, maybe AA plus in some cases, and government bonds. So you will always have government bonds plus good quality corporate bonds in the core bucket. In the risky bucket, if you want to take some risk on the fixed income side, you can take two types of risk. And for that, you can essentially have what is called as a dynamic bond fund category, where there is an active fund management happening. The fund manager and his or her team is taking active calls on the interest rate, and you may probably get even a double digit rate of return sometimes if it is played out well. And the second category you would want to have in the risky category is what is called as credit risk fund, where there will be some risky securities that could be bought into by the fund management team. So the core investment should be into government bonds, corporate bonds kind of portfolio. The risky ones can be in dynamic bonds and credit risk fund, just to summarize.
All right, which category of fixed income funds are the most appropriate for this market phase?
So currently, if you look at the yield curve, as I was explaining earlier, most of the value is in the 4, 5, 6 years kind of horizon. That is where the yield curve is a little bit on the higher side, which means there's a lot of value in which you can absorb the yield difference there. So for that reason, what I would suggest is at this point in time, any investment scheme, especially government bonds, that are maturing in that 4 to 6 years investment horizon would be very, very lucrative to get into, because there would be some compression on the yields at that level, and that could lead to some capital appreciation also. So you will get a coupon accrual income of 7% plus a potential capital appreciation of maybe a percent or so over the next 3, 4 years. You could probably get about 8% or so from a very safe fixed income kind of investment. So I think that's very lucrative at this point in time.
All right, before we go ahead, I would request all of you who are watching the stream right now, do hit the like button, follow Harish on our page. Moving on to my next question. Which active funds category are suitable in the current environment?
So there will be two categories which I would recommend from an active funds point of view. One would be the dynamic bond fund category, where the fund management team is reading these interest rate cycles very carefully, and they will be able to maneuver the right strategy for this kind of market. And they will also shift to a different strategy as soon as the interest rate cycles will change. So dynamic bond fund category always gives you that edge because there is someone actively managing your money and moving into the right buckets at the right time. So that's one category, dynamic bond fund category. The second category which I would recommend is a medium duration bond fund. So pick a corporate bond fund which has a duration of close to 4 to 5 years. You will have a edge there because you're not only investing in that right bucket of 4 to 5 years, you're also investing in good quality corporate bonds that offers what is called as credit spread. So you can lock into these yields and just wait for the next 4 or 5 years. And as I said, maybe 8 to 9% yield could be earned from this kind of strategy.
All right, Harish, we have a couple of questions coming in from the viewers.
Sure.
So, Kevin wants to know, is this a good time to invest in equity mutual fund for a long term basis?
It is always a good time to invest in equity mutual funds for a long term. There is never a bad time. I personally believe that India is entering the next 2 to 3 decades of high growth. A lot of things are working for us. The political situation is good. The economic structure currently is very good in terms of the deficits that we're managing. There are a lot of tailwinds we are getting from the perspective of India being an oasis in a global slowdown scenario. So in all these long-term structural stories, it's always a good time to be invested for long term.
All right, Kevin, I hope your query has been solved. Now, Jatin wants to know which debt funds are best suited for investments both in shorter end and longer end tenures.
Sure. So I would not be able to recommend specific fixed income names or the name of the funds here due to SEBI regulations. But as I said, for short term, and by short term I mean less than 3 years, you would want to look at short duration debt funds. Look for debt funds which has a high component of corporate bonds and treasury bills, as in government bonds, and look for this 2 to 3 years duration for short end. For medium to long end, look for dynamic bond fund category, where, as I said earlier, they will be able to maneuver the interest rate cycles well. If you want to avoid the dynamic bond fund category for whatever reason, you can look at a long duration government security fund. Pick any government security fund because essentially the investment is going into a government bond. There is no risk in that from a default point of view. Pick a 7 to 8 years duration and park your money there for long term.
All right, getting back to my questions, Harish. So we were talking about active funds category. So how are passive funds providing options for core fixed income portfolio?
So over the last 3 years or so, we have seen a rapid increase in passive fund offering in the fixed income category, which is a very welcome sign, because for those investors who know what they want to have in their portfolio, they don't want an active fund manager to tell them what is needed, and thereby they can avoid the cost of the active fund management. So the difference between an actively managed fixed income portfolio versus a passive debt fund will be the cost. You can save literally about zero point 0.3 to 0.5% every year. And in the context of fixed income investing, where you're expecting 6 7% yield overall, even a 0.5% increase in returns is a significant rate of return. So that is where active funds have positioned themselves. You can now get active funds pretty much in any category that you want. So for example, you can pick a 5 year government security passive fund. You can pick a corporate bond fund, which is passive. You can pick a PSU bond fund, which is passive. So there are a lot of these offerings which are available now. Most of the fund houses are offering. The pioneer, I think, in this category was the Bharat Bond ETF, which was brought in by Edelweiss. And Bharat Bond ETF has now brought in offerings in government bonds, corporate bonds, state development loans. Same way, there are other fund houses like IDFC, for example. IDFC has brought in the passive funds for government bond index for 4 years, 5 years, etc. So what this is doing for investors is they're offering a choice. They're basically saying you can go to active fund managers, no problem. You will have to pay a higher cost for it because there is a seasoned fund management team working for you, or you can just pick these passive funds. There is nobody actively managing it. You have to manage the risk, and you can thereby save the cost. So the offerings have come up in a big way, and that's really heartening to see.
All right, now Jatin Gulati wants to know which would be the best fund category for up to 1 year: money market, low duration, or ultra short duration.
I would suggest ultra short duration for up to 1 year. So ultra short duration caters to 6 months to 1 year category. So if you want to keep the money for about 1 year, ultra short is the best fund category to be in.
Mahesh wants to know for monthly income, what can be the right investment?
It depends a lot, Mahesh, on what is your investment horizon also. So, for example, if you are okay to lock in your money, keep it invested for, let's say, 5 years, you can invest in a corporate bond fund category for 4 to 5 years duration. And every month, whatever is the appreciation you're getting, you can redeem that. Please keep in mind that you may not get dividends in the form of monthly income. You will have to create monthly income in the form of certain redemptions you will do from the units in the form of what is called as systematic withdrawal plan. So if you can pick a 4 to 5 years duration, good quality corporate bond, keep your lump sum there and go for systematic withdrawal plan, I think that would be the best bet at this point in time. But if you cannot invest for 5 years, if you only want to invest for 1 year, 2 years, then please don't go for corporate bond fund categories. Look for ultra short or money market categories and then do a systematic withdrawal plan.
Hope your queries have been solved. Now, coming to my last question, Harish, what are the key risks to be considered at this point of time regarding the fixed income assets? And what can be considered as a viable fixed income investment strategy?
The most important risk in this cycle, where interest rates have been increased over the last couple of years, is that the cost of borrowing has gone up for many, many corporates. And the corporates whose balance sheets are not strong, whose cash flows are not very strong, they will feel the brunt of the higher interest cost. So a lot of them have borrowed at lower interest costs 3 4 years back. They have used that money in many cases in a very efficient way to create a good business, but there would also be a lot of corporates who have not been able to do that. So be very, very uh, aware of the credit risk in the portfolios that you're creating. So be very conscious of what is the kind of corporate bond papers that the mutual fund is investing into. If you're going through a mutual fund, if you're investing directly, look for the credit ratings of these papers. I would strictly recommend that you avoid credit risk at this point in time if you are creating a core portfolio. I did mention credit risk in a satellite portfolio, which means you can take some risk in it. But if you're trying to create a core portfolio, stick to AAA rated papers only, stick to government bonds only, probably a double A plus, but again, it's very risky in terms of which double A plus actually is really strong in that sense. So the biggest risk at this stage would be the credit default risk. So I would urge all of you to be very careful about that.
All right, we have more questions coming in, Harish. So, Gaurav wants to know, are we heading into recession in years to come? Should we hold on to the investments?
US is likely to get into a technical recession, is my reading. And when I say technical recession, it is basically 2 quarters GDP in negative GDP growth rate. So it doesn't necessarily mean that the world is going to end when you talk about recession, because you need to be careful when economists talks about recession. It's more a technical factor that they're referring to. If you look at the actual economy in US, even if they go into a technical recession, their job market is still strong. So there is a possibility that US could slow down and there could be a technical recession there. I don't expect that to happen in India, because again, you need negative growth rates for recession to be technically happening, and we are far away from having actually a negative growth rate. So India may slow down if US goes into a technical recession, because a large part of India's economy is still driven by the external earnings that we get. So there would be a slowdown for sure, but that doesn't mean that you change your long term investment strategy. Any corrections in equity markets would become an opportunity for you to invest for long term. COVID was a classic example. COVID crash in 2020, most people were scared and they exited, and now you can see that markets are much above those levels. So, as long as you believe in the India story, which I do, for the next 2 to 3 decades, I think you should always be invested for equity. As far as fixed income is concerned, when a country slows down, if it goes into even a technical recession, interest rate tends to go down. So, you will get capital appreciation if interest rate goes down because bond prices go up. So that's why I said earlier, stick to that 4 to 5 years investment horizon bucket. you could actually be surprised that you may make some capital appreciation as well. And I will not be very surprised if interest rates are cut in the next 2 to 3 years, you could actually get 8-9% yield also from a very safe fixed income investment.
All right, Mukund wants to know your thoughts on funds like Nippon Lakshya Fund, where the YTM is 7.
I do not track that fund, Mukund, so I'll not be able to. I'll not have any view on it.
All right, Gaurav, I hope your query was solved. And then on that note, thank you so much for your time, Harish. Well, that's all for now, but do stay logged on to ET Markets live stream for more investment ideas.